Before you refresh that chart one more time, before you fire off a text that says, "We're in trouble," before you start calculating what you could sell just to feel like you're doing something, stop. Because if you clicked this video thinking you were about to watch silver collapse, if you came here expecting confirmation that the trade is over and the bubble finally popped, then you're about to get exactly what you came for. Just not in the way you think. What you're looking at right now isn't a market crash. It's a trap. And if all you see is red candles, you're staring at the wrong screen. I need you to understand something right away. You're not crazy for feeling that pit in your stomach. You're not weak for feeling the fear. That reaction is the entire point of what just happened. Because while you were watching prices plunge, while silver was shoved under $90 and gold was driven straight down, something very different was happening behind the curtain. The chart is screaming panic, but the vault data is whispering something much darker. What you're witnessing is not a sell-off. It's a bank run disguised as a crash. It's Friday, January 30th, 2026. End of the week, end of the month. And right on schedule, the people who control the levers decided to throw a party. They dragged the silver price out back and smashed it from over 120 to under 90 in a single day. To anyone watching casually, it looks catastrophic. It looks like capitulation. It looks like the trade is dead. But that reaction only happens if you never look past the surface. Because if you wipe the emotion off your screen and actually look at what happened today, you'll realize this wasn't the end of the story. It was the moment the mask slipped. If you don't live in this world, here's how it works. You can roll it, sell the near month contract and buy the next one, staying safely inside the paper system, or you can do nothing. And doing nothing is the most aggressive move there is because it means you're demanding physical metal. You're saying you don't want cash, you don't want exposure, you want bars. They rely on fear. That's why they always smash prices right before first notice day to scare holders into running away. This time, they hit the price harder than usual. They didn't roll, they didn't panic, they didn't flinch. They stood still and said, "Deliver." What followed was something you almost never see. According to the CME's own data, the February gold contract saw over 20,000 delivery notices issued on day one. Not 10,000, not 5,000, over 20,000. Each contract represents 100 ounces. That is more than 2 million ounces of gold, roughly 63 metric tons, changing hands immediately as the price was falling. Think about that for a second. Why would anyone demand delivery while the price is dropping? Why would anyone take a losing asset? Because they know the price isn't real. Because they understand that paper numbers don't matter when the system itself is cracking. 63 tons of gold moved from sellers to buyers at the exact moment retail investors were being told to run. This is the kind of behavior you only see when the biggest players on earth are losing confidence in the paper game. Sovereign entities, central banks, deep-pocketed institutions quietly removing metal from the system. And when you follow the trail of who actually delivered that gold, the picture becomes even clearer. The largest issuer of delivery notices was JP Morgan. Over 11,000 contracts. That's more than 1 million ounces of gold coming straight out of their vault. But here's the trick. They weren't just delivering. Another arm of JP Morgan simultaneously took delivery on nearly 8,000 contracts. Metal out, metal in. A shell game designed to obscure what's really happening. They're shuffling gold between accounts, trying to satisfy external demand while masking the drain. Meanwhile, Deutsche Bank and UBS are coughing up thousands of contracts of their own. European vaults are bleeding, and the scale of this event matters. On a normal first notice day, a few thousand contracts might stand. 20,000 is not normal. It's a statistical anomaly. The price smash didn't work. The buyers absorbed it. The paper mechanism failed to scare them away. And that alone proves the screen price is lying. The real operation targeted silver, because silver isn't just money, it's industrial, it's strategic. And when they smashed it from 120 to 90, they expected panic buying. You tried to buy the dip, and you couldn't. Dealer websites froze. JM Bullion went offline for maintenance. London's trading systems went dark. This wasn't coincidence. This was a lockout. The price collapsed, but access vanished. Ask yourself honestly, does it make sense that major bullion dealers chose the most volatile trading day in history for scheduled maintenance? Or does it make more sense that they pulled the plug because they knew demand would wipe them out instantly? At $90, inventory wouldn't last 10 minutes. And with paper markets in chaos, hedging was impossible. So they did the only thing they could do. They turned off the lights. And it wasn't just retail being blocked. The Chinese arbitrage desks that normally rush in to buy discounted Western silver were locked out. The bid disappeared. The price fell into a vacuum. When prices rise, margins go up to stop you. When prices fall, access disappears to stop you. Heads they win. Tails you lose, unless you understand the game. They smash the paper price hoping you'll panic and sell the real thing. They want weak hands. But something went wrong. Because while the retail pipes were clogged, someone else stepped in. To understand why this matters, you have to understand the plumbing of the physical silver market. Not all silver is equal, and right now, the bottleneck is junk silver, pre-1965 constitutional coinage. Refineries are overwhelmed. Industrial demand is crushing capacity. They don't want dirty scrap. They want clean feeds. Got stuck holding inventory they couldn't move. Cash dried up. The bid disappeared. The liquidity trap was complete. This was the moment the banks expected you to break. David Bateman, not a bank, not a hedge fund. While websites were down and shops were frozen, he stepped in and put a floor under the market. This is what smart capital looks like. It doesn't need an app. It doesn't need permission. Despite the crash, speculators are not shorting silver. The data is undeniable. SLV borrow fees are near zero. Tens of millions of shares are available to short, and nobody wants them. That should terrify you because it means the people who usually profit from crashes are sitting on their hands. They see the same thing we see. Prices in China are far higher. Prices in India are higher. New York is the outlier. Shorting silver here is suicidal, and the hedge funds know it. A small number of bullion banks dumping paper contracts in desperation. No one did. JP Morgan's research desk just put out a forecast calling for gold to reach $8,500. While their trading desk is smashing the price, their strategists are telling wealthy clients the real destination. This isn't contradiction, it's strategy. They suppress the price to accumulate. They shake the tree to knock loose weak hands. Every share sold in panic is scooped up quietly. This is classic distribution and reaccumulation. And the structural reason is simple. Global capital is reallocating. Private investors are increasing gold exposure dramatically. Pension funds, sovereign wealth funds, family offices, they're moving out of paper and into metal. That shift alone justifies far higher prices. It means you're living in a decoupled world. There isn't one price anymore. There are three. The New York paper price. If you sell based on the first, you're donating wealth to the third. Every ounce sold in fear ends up east, and the spread you're seeing right now is the crack that proves the system is breaking. Low prices don't fix shortages, they accelerate them. This wasn't a crash. It was a coordinated attempt to manufacture fear, suppress pricing, and extract physical metal from weak hands. The price discovery mechanism is broken. Geography now determines value. Do not let a red candle in New York convince you reality has changed when the rest of the world is paying more. If banks believe gold is going to 8,500, selling at 5,200 makes no sense. If China is paying 132 for silver, selling at 108 is insanity. This window won't stay open. Arbitrage always returns. And when it does, the merge won't happen at the lowest price. The game is rigged. The spread is real.